Welcome to the Techno Fundamental Report for February the 2nd. I just finished a very good book called The Outsiders, and it's about chief executive officers that had very special skills. The study was done by Harvard Business School. They went back to the 1950s and they determined the very best performing stocks. Then, using that criteria, they went and looked at the CEOs that ran these companies. And they found out that the most important characteristic that they had was something called capital allocation. So with capital allocation, what it is where cash comes into an organization. So how do you spend it? Do you spend it on the company? Do you pay dividends out to the shareholders? Do you make acquisitions, or do you do a stock buyback? Well, in most cases, the people that were the CEOs that were so special tended to be left-brained type people where they were very analytical in their thinking. Not to say that the right-brain people weren't talented as well, but what they really were special at was being able to know how to do capital allocation. Most of the big winners bought their stocks back. They paid very little in dividends, and you'll see what I'm talking about when you start looking at return on equity. But also I wanted to mention that these people were just ordinary people. However, one was an astronaut who orbited the moon. One was a widow with no prior business experience. There were a total of 8 CEOs that the book identified. So I would recommend the book highly, and I think it really is important to look at the management of the company, and you're really wanting to see that left-brained type of personality. Now, return on equity would be the way to see the results, because assuming all else is equal, companies that have both a higher return on equity and higher profit retention, in other words, retaining cash versus sending cash out the door, are usually the ones that have the higher growth rate when compared to companies that don't have the same features. So return on equity, we pay a lot of attention to it. Think about it as this way. If a company has a 20% return on equity, that means for every dollar of equity, they make a 20% return on those dollars. I did also want to mention that the economy, everyone's talking about recession and so forth, and you have to kind of take it a day at a time. But this is delinquency rate on credit card loans. You can see, relatively speaking, quite low. Now, this was the recession back in '08, the financial crisis. You can see that the delinquency rate got up to 6.5%, 7%, whereas right now it's down to around 2%. Let's just look at the market now. Let's see what's going on here. We are seeing some very positive action. The NASDAQ has now broken above that 200-day moving average, has broken out of this little base here, but is now in an uptrend. So things are looking bullish here. Here's the mid cap, same thing. You got the uptrend, you're above the lower moving averages, you're breaking out of that base, and then really breaking out today. Today was a very strong day for the market. The New York Composite, same thing, breaking out of a base above the lower moving averages. So this looks very good. Small caps, which tends to be the risk-on category, breaking out in a big way. Moving averages are turning up. Looks very positive. Standard & Poor's 500, same thing, breaking out of a base, moving up. We're looking good here. Just to kind of look at it in relative to the 200-day moving average, you can see here we're starting to see that uptrend. In other words, you take that low, then you rally to a high, you make a higher low, higher high, higher low, higher high. That's an uptrend. Now, the NASDAQ is also breaking above the 200-day moving average. This is very positive. Now, stocks above their 200-day moving average as a percentage have gotten up to 71.69. So you can see here back in October when we made the major low, we got down to readings of under 15%. We're now over 70%. So again, we're seeing strength here. Volatility in a downtrend. So with low volatility, that's a positive. Here's the aggression index. This is where we're comparing the NASDAQ to consumer staples. Has broken above the lower moving average. Lower moving average has turned up. It is now on a buy signal. Now, if we just look at another aggression index, which is the NASDAQ compared to the S&P, it's above the 10-week moving average and turning up. That too is on a buy signal. Now, to just go back in history a little bit, just to look at this particular indicator, this is the low of the market back in the 2000 dot-com bust. We came out of, actually the market broke out in March of 03. However, you can see here that with the aggression index, it broke out above that lower moving average, got above the upper moving average. The lower moving average turned up. So just to kind of take another snapshot here, we're breaking through those moving averages, lower moving averages turning up. This is a positive situation. Now, our three economic indicators, you can see interest rates are really not going anywhere but down. Here's the 200-day moving average, very close to breaking that. The price of oil is rolling over. The financial stocks, however, have developed into an uptrend along with the market. New lows on the New York Stock Exchange, under control, very positive. This is on a buy signal. This is the high-yield corporate bond fund. I wanted to point this out. It is breaking out to the upside, which tells me if the market was worried about a recession, junk bonds would not be breaking out to the upside. Now, a particular stock that we're going to look at fundamentally and just be aware of, this is Academy Sports. They're based out of Katy, Texas. Very popular stores. You can see the stock is really starting to get into a nice uptrend here. We've got above average, we got a good volume signature here. No problem on volume. Then if we look at the fundamentals, they're really exceptional. I mean, profit margin for a retailer around 10%, which is very good. However, return on equity, 42%. So when we think about the management of these companies, this is how you manage it, because the way they're getting a 42% return on equity is that instead of doing equity financing, they're doing debt financing. So they've got debt of about $1.9 billion, which is a lot. But if you look at their cash flow, they're able to cash flow the debt without any problem. So in other words, after their debt payments, they still have $227 million in cash for the last trailing 12 months. Now revenues $6.4 billion. They were down a little bit. Quarterly earnings were down. However, we're dealing with that COVID issue. Cash, $318 million. We're in good shape there. Current ratio, 1.5, 1.6 to 1. Would like it to be more like 2 to 1. But this is a pretty solid looking situation, and the chart, as you can see, is very positive. The CEO is Ken Hicks. I've looked through this. The man is clearly very experienced in retail. He's been with many companies. And I think what's interesting is his education background, which is he went to West Point Military Academy, served in the U.S. Army. He also earned a Master of Business Administration with highest distinctions from Harvard Business School. So Ken Hicks is running this company. High return on equity tells me he knows what he's doing. He knows how to do capital allocation. Call me if you have any questions. Thank you very much.